Good evening, everyone, or not so good evening, depending on which side of some of these trades you were on. Believe me, I'm right there with you. My P&L is very red today. So you are not alone. We will go through this together, and I will explain to you what happened. So this was not a crash. This is not a stock market crash. Um, what has been happening here is as we come up today to 12 o'clock my time, that's when the FOMC minutes were released. And the FOMC minutes are just the minutes of the meeting that happened several weeks ago. December 15th was when they came out and, Powell talked and then put out the statement and all that. It's just the minutes. And normally the minutes don't really move the market. But in the minutes, they were a little bit more hawkish than usual, and apparently that caused what we see here. So, first of all, like I've been talking to you guys for a few videos now, this was already, in my opinion, already priced in. And we can see right here, we've got let me refresh this, the March expectations 67% for a rate hike. Okay, this is increased. Today it's increased a little bit. We can see 64, 3.5. It came up a few percent today, but this was already priced in. It was 60% a week ago, so it was already priced in a week ago that they were going to raise rates in March. Okay, the people that play this are the big boys that play these futures. Okay, these are big mutual funds, big hedge funds. These are people with millions and millions and billions of dollars under management that play these things. They already knew it was going to happen in March. Okay, we are going to get a rate raise. Let me actually bring that thing back up. The end of the year. Show you this. This is in December. So the target rate in December, there's also some concern that it's going to go over, that about 1% level in the Fed. The Fed funds rate would be over 1%. We would need to have only 3 rate increases to be under 1% by then, unless you have like a really big rate increase. Normally they're in 25 basis points increments. But we can come over here and look, and we can see 23, so that's 30, 40, 44%. There's already about 44% probability in the market that we have an over 1%, just 1% plus rates by the end of the year. That's already baked in, over 44%. Okay? The prices that we're looking at right now have these things baked in. So when the market fell today, the question is, why did it fall? A few reasons. Number one, retail. Okay, retail got scared out of their minds. They're the ones that have been dumping treasuries over the last few days, that have sent treasury rates up to 1.7% right now on the 10-year. They're the ones that have been dumping the treasuries. It's not the big funds. So they've been dumping those. Retail scared out of their mind over rate increases because they don't understand what's happening. It's the reason retail is generally called dumb money. And they started to sell. And a lot of the rest of this, I think, is algos and hedge fund short sellers. That's what I think a lot of this was pushed down by, was just algorithmic trading and big hedge funds just trying to short down the markets. And that could be for a couple of reasons. Number one, to make money on the short, and number two, so that they can buy lower. Big funds with lots of money will try to move the market like that. And I think that's a lot of what this movement down was today. We are right down here, just below this 4,700 number. I want to show you. So this rectangle area, zoom out to like 1 hour, was the close on December 15. It was the close on December 15, which was Fed Day. Okay, so consider this: the market at the end of the day on Fed Day decided a fair value for the S&P 500 futures was 47.02. We're pretty close to that. We're within 7 points of that right now. Okay, pretty much the same price. That's what the market determined was a fair value after hearing what the Fed had to say. But this was before Omicron got resolved. Immediately following it was more concerns over Omicron and I think over like more. This was when there was like a rate hike out of the Bank of England or something. But anyway, a lot of this was Omicron fear. And then Omicron kind of got resolved and the markets came back up. You guys all remember this? This was December 20th, before Christmas. Okay? Right here was Christmas. All right. So if we look back over here and we ask ourselves, what has happened between when they came out over here with the statement and the press conference after the Fed meeting? What has happened between then and now? Okay, nothing in those FOMC minutes was a surprise. If you're paying attention, which I assure you the big boys are, if you're paying attention, nothing in the FOMC minutes was a surprise. And that's why you have things like these futures have been predicting this for a long time. They've been predicting that in March we will have a rate rise. Now, if you look here towards the end of the year, it's still, most people are saying it'll be 1% or less, but we are getting a lot of people coming in here saying it's going to be over 1%. So right now we've got to keep our eyes on this. But as far as how many raises we're going to get, I think 3 is baked in. I think 4 would be a little much. But right now, it's very baked in that March is going to happen. Now, the only thing that's changed between this meeting and now is that we've gotten more resolution on Omicron and the Fed and the FOMC minutes release. That's it. That's all we've gotten. Okay. All this push up after Omicron, after we've heard this news on the Fed, the market decided that this was a fair value. Okay. This whole area was, see how it's just been consolidating here for days? That's because the market found fair value. It found equilibrium. It said, this is worth somewhere between 47.47 and about 4,800. And it actually went a little over 48.08. Okay. Now with this big pullback, you ask yourself what has changed. Well, nothing. This is actually better than where we were economically speaking back on Fed Day, because Omicron has been determined to not be as big of a threat, and the Fed is actually taking action to stem inflation, which would be a worse villain, in my opinion, than tightening money supply as far as the market is concerned. Tightening money supply through ending their buybacks, raising the Fed funds rate, and dumping stuff just off the Fed balance sheet. Tightening money supply in that fashion, yes, it's going to hurt those high growth companies. So you've got anything that's super high growth, doesn't actually make any money, relies on debt, is going to get really hurt this next year. It's not going to be a good place to be. It won't be a good place to be. Something like Uber, right? I think they may have finally turned a profit, but they massively have just been burning cash for forever. Any company that is burning cash, relying on borrowing money to stay alive, is not going to do well this year. And we need to look more into the value side of the market. And again, that's just because of the tightening money environment, the tightening monetary environment. I think inflation will be more damaging, though. Inflation will cause a lot more problems in the overall macro economy than just tightening monetary policy is going to cause for a few companies. Okay. This is a massive overreaction. Which I think was driven by, again, I think it was driven a lot by like algos and big funds just trying to drive down the price. I'm imagining this is just going to turn into like a big, like kind of a hammer candle on the 4-hour kind of thinking that this is just going to pop way up and then it'll start to come back up. Although we could see tomorrow, we could see, where's my little drawing tool? Let's grab the open tomorrow. We'll jump back down to the hour. The open is, this is just after the open, right there. And the close for tomorrow, see 6 January, closes right there, down to the 15. Okay, so here's open and close on the market tomorrow. Okay, and this is all your overnight action. What we could see here is, now I think the markets are going to stay a bit weak overnight. London's going to come in here and say, what in the devil's going on, right? And I think the markets will stay a bit weak, right? So we could see just some stuff kind of like this going on. And then what I want to see maybe is like a gap up, maybe a small gap up to this kind of an area as we come into the day. And then I do think it's going to sell off. I think if we gap up, it's going to immediately dump. Like within the first 30 minutes, it'll dump at least back down to the close, if not a little bit past it, maybe down here just a little bit. And then I think we come up, kind of find our footing, and then V upwards the rest of the day. Maybe not that high, but I could see it back up to there, that 47, 43 level. This is kind of what I would see happening. The market ended very, like there was no jump at the end of the day, so I didn't see a lot of short covering. Here. So we have a lot of shorts still sitting in the market, and we can jump in here at the end. Okay, right here at the end, there was no short covering. Normally you'd see a big pop, right? But without that, there are shorts in the market. We know that. They are going to get stopped out at some point. When they get stopped out, that's if the markets come up. When they get stopped out, it's going to jump. And I have to imagine a lot of stops are going to be at 47.20 and 47.30. And then probably back up here in this 47s 40s range. This would probably be your big hedge funds are going to stop out up here. Okay? So if we can get above that area, I think we get a nice intraday short squeeze. If we start to pop these levels, if we get above 47.20, I think it just chain reactions. Okay? If we get above 47.20, I think it will chain reaction up. If we cannot get above 47.20, if we can't get above that area, then we could have more downside. Look back here a little bit. You see this 47.20 remains important going back. You can see there's numerous places that it hits. So that's why this is kind of my dividing line on my bias for tomorrow with taking day trades, if I'm going to take long or if I'm going to take short. It is going to kind of be that 47.20 line. It won't be here. Like I say, I think it's going to be here because we got to find the stops. As far as on the downside, let's look. Our next support levels be 46.60 on the ES will be our next support level. That's a nice fib retracement. Actually, let me readjust that. 46.64 will be that level, and you can see we do have hit there. So I think that's probably a solid level. I've really got to imagine this is where it stops. If it dumps, like I was saying, off the open, it could dump hard. You could see this 30-point drop, and then it comes back up in kind of a V-bottom thing. I wouldn't be too surprised to see that. But what we want to see is that quick pull down and then a hard hammer right off of it. And I think that'll signal our bottom if that happens. Otherwise, it could just go up. And like I say, this 47.20 is going to be my signal to get long. I did enter a tier 1 on some calls today for SPY. If we can break this area, I'm going to get long in more of them and ride it back to the top. If we can't, if we stay underneath today's close, apologize for the noise in the background. If we stay under this 4,700 here tomorrow and we close under it and we close red, I'm not too hopeful on that, unless it's some sort of hammer, right? Like we drop all the way down here, and then it pushes all the way back up, and it just can't quite make it, but it makes a hammer candle on the daily. That would be okay, and I would expect to see a follow through up the following day, up through this 4720 area. But if it's just something like a straight down, it ends at lows of the day. Um, that could be bearish for further pullback in the markets. So anyway, that's where I am. Those are my levels for tomorrow, and that's going to kind of determine what I do. We had to roll a number of things today. I'm hoping that we'll be out of those by next Friday. We can just kind of get rid of them. And go on our merry way. One thing about these big pullbacks, everybody keep in mind, this is a quote from John Carter. I love John Carter. If you haven't read his book, Mastering the Trade, you should go read it. He says, the difference between a $20,000 a year trader and a $200,000 a year trader is courage. And when we have these big pullbacks, guys, it takes courage to step in here and buy. It takes courage to read the charts, to understand what's going on, to put your fear aside, get in here and buy and enter the markets at their lows, near their lows, right? So what we do is we watch this, we see this happen. I get a little bit of a position here because I want to be in a little bit here at the bottom. Comes back up, I get confirmation of the move, and I jump in. But we're still way down here at the lows, okay? And it takes courage still to jump in here and not just wait for it to come back in and sell off and hope you got a little bit of money back. You know what I'm saying? It's that emotional roller coaster. So keep in mind, keep your emotions in check, guys. Keep your egos in check. Keep your fear in check. And I will see you all tomorrow. Have a good evening and take care. Bye bye.